Hey everyone, it's Evan here from The Trade Risk on Friday, May 11th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and then finish off looking at some sector analysis. I hope everybody's doing well out there. Hope you had a nice week trading. Let's overview what we're going to talk about in this video. First and foremost, we got the Russell 2000 closing at new all-time highs. Needed a little under 2%, I think, on the week to get those new highs, and it got it done. So that's the big news. Market overall, though, broad-based rally right across the board, but the Russell is certainly the standout. We got earnings season now, which is mostly behind us. We've got through the sort of hump of it, and we've got most of the companies that have already reported. You still need to check those dates because we still have names. We're still in season, but we do have the majority of names behind us now. And lots of good things to talk about in this week's video, or constructive things for the bull case, but there is one sort of contrarian sentiment indicator that is suggesting there is some complacency out there now. We're going to talk about that, given the market has had a nice rally over 5 or 6 trading days. So lots to cover. Hope you'll stick around for this week's market recap video. All right, let's jump in here with the S&P 500. We're looking at the cash market, and we're going to start with the big picture like we tend to do in these videos. Look at the big time frame to get that top-down perspective. This is a weekly chart of the cash market. Each bar represents 1 week worth of trading on this time scale, and you can see here on the week, almost 2.5% to the upside for the S&P 500. So a nice and strong bullish week here for the bulls, really making some progress to the upside, something we haven't seen now in quite a while, really, especially getting back to the levels that we now see ourselves at. So when we zoom in here on this chart and we look at the price action, we see this nice bullish 2.5% move, and we are breaking above this downtrend line that extends from the highs here of 2018. Now, one slight rant here on trend lines. You're gonna, as you follow your favorite technicians and you look through your blogs and all of the chartists out there, you're gonna see this trend line drawn in all different places. Some are gonna have it lower, some are gonna have it higher. They're gonna have it angled a little different. In fact, if we go to the SPY ETF, in fact, I think I still have it drawn here. So you can see this version here of the SPY. I used the very, very top. I did this intentionally to use the very, very wicks, the tops of all of these touches here. And you could say right where we close that we still haven't quite broken out yet. So there's lots of ways to interpret this, and no one way is better than the other. There is sort of an art to it. Everybody's going to have a little bit of subjectivity on how they draw these. My approach, or my advice, is generally speaking, for you when you're charting yourself, stick to a style, or stick to a way you like to sort of connect the dots, if you will, and just own that and just continue with that and be consistent with it. For me, I generally don't connect the exact tips, the wicks here of candles. I generally go down to the body, personal preference, and I like to just kind of, get the majority of the move. I'm not so precise on what the exact breakout level is. This is sort of why I prefer horizontal levels versus trend lines, because there's less subjectivity in it, generally speaking. So that's sort of my comment there. So again, if you don't think we've broken out yet, that's totally cool. I can get behind needing to rally another 10 handles or so to get that breakout in anyone else's mind. But to me, we're breaking above this trend line. And again, that doesn't mean we have to just all of a sudden go off to the races here. We could easily kind of drop back below it next week. The point is some good progress. We did clear above all of nearby resistance levels, which we'll look at when we go down to the daily chart. Specifically, the highs here back from the 20th of April, we cleared above that, and we are now coming back into this choppier zone that we spent most of February in, and then the pivot high up here in March. So from a weekly perspective now, we're getting, if I had a MACD on here, we're starting to get, or my version of a MACD, if we look at the 8 and 20 period moving average here, you can see starting to get bullishly aligned, starting to get some momentum picked up here. So if the bulls can continue, if they can hold on to these gains, if they can build upon this rally, this is an excellent start to a potential recovery back towards higher prices. Some real sort of technical repair and progress was made on the bull case this week. So now let's go down to a daily chart, and let's go down to the S&P 500, I'm sorry, the SPY ETF, I should say, and let's just kick it back to this view here. So for me, I think the interesting day happened on Wednesday. To me, I think this day here on Wednesday was when we really got that breakout going. This is when we broke above this kind of dual trend line area here. So this trend line that extends from the March highs down to the April highs, and then all the way back here where we broke out above it around 267. We also have this more shallow near-term trend line that we broke out from on Wednesday, just from this most recent pullback. And then we have these horizontal levels, 266, 267. We talked a lot about this on Tuesday's video, but this was the cluster right here. This was the bullseye that we wanted to see the market kind of break above, and it did that. It did that strongly here on Wednesday. We had a nice close. Volume this week wasn't anything impressive. It was a fairly light week worth of volume as we started to move to the upside, but regardless, from a price action perspective, we cleared above all of this near-term technical chop and mess, and we did extend ourselves, and importantly, we closed the week strongly, which is something, again, we haven't seen even back here in April when we got up to these levels. We rolled over into the end of the week. So we saw a price breakout of short-term levels. We held those levels, and we closed strongly. So this is the S&P 500 now. We got a short-term trend that is higher. It is extended a bit in the short term. And when we think about levels to look at, looking ahead, looking in front of us, we'll very quickly kind of come back if we notice this zone right in here. So we are quickly kind of approaching the top end of this. If you look at, say, right around 275 or so, you can see we spent a decent amount chopping around here. It was a bit of an inflection point from a couple of times. Even way back in January, we had this little stutter step here, and then kind of right up, in mid-February as we kind of chopped around in this level. So this 264, 265 area right in here might have some hesitation. There was some chop, so there's some previous price memory up there. If we start to get back up there, any bag holders from in here are going to want to sell. The same kind of story we know and love about price action is going to be is going to really unfold itself if we get back up there. So 274, 275, right above kind of current prices. That's where I'd be paying attention to. And then if we can start to clear and just cut right through that, we have the old highs back here from February and March, almost at 280 or so, right south of 280, right around 278, the upper 270s. There's some prior pivots in here that the S&P 500 is going to have to deal with. So those are the levels on the upside. I think more importantly would be getting through this 274 zone, because there was, again, a good amount of price traded in here back from earlier this year. So I think that'd be the more interesting spot I'd like to see this market clear, or see how it reacts to. If we can start to go through there, then suddenly we could start to move pretty quick. But in the short term, we are up now. I know in the IWM we're up 6 days in a row. The S&P 500's gone pretty much in a straight line here to the upside. So in the short term, we do have some extension. We do have some overbought conditions. So don't just run out and buy everything on Monday. I think there's you got to have a little more thoughtfulness to allocating here, even though the bulls did make some good progress. So those those are essentially the levels I'd be looking at on the upside. Now on the downside, if we start to see things roll over, if we start to get a pullback next week, which again, because we are overbought in the short term, would not be unreasonable. But if you're a very short-term trader, if you're very acute looking at this market closely here, I'd stay right around 270, 271 or so. That's going to be your upper level kind of prime momentum spot you would want to see this market hold. We did have kind of a gap and go here on Thursday, so we do have a bit of an open gap here that the market may want to fill. So if we do kind of pull back 270 or so, fill that gap, if we can hold there, if we can put in a higher low, let these moving averages catch up, I think that would be constructive. On the flip side, what would not be so constructive is if we saw just a hard slam down, high volume drop, losing 271, losing this pivot here from April. I do think this pivot is kind of interesting and important to pay attention to. That's this pivot right here. So again, if we very violently kind of lost this, and then we suddenly have a double top looking kind of, intermediate term candle or, structure here, that would not be, in the bull's best interest. That would not be a good kind of development here going forward. So I do think this level, 270, almost all the way up to 271 or so, I think that is an interesting upper level to pay attention to. And then most importantly for me, it's this cluster all the way back down here right around 268 or so. If we start, falling way back below 267, 268, south of 270, that's when I'd start to get more concerned that, this breakout maybe isn't as good or as ideal as many people think it is. So those are sort of the near-term levels I'm paying attention to in the S&P 500 on the up and down side. One interesting indicator that I want to talk about, so to be clear, I do think there was a lot of good constructive action that happened this week, especially when we look at the IWM, which we will shortly. But, one thing I'm going to point us to here is a bit of a contrarian indicator here, and shout out to Vanky on Twitter. He posted this chart, which brought it to my attention. This is not something I look at all that frequently, but it is the put-call ratio, and specifically we're looking at the put-call ratio in terms of just equities, and I don't think this is actually updated for Friday's close yet. I'm recording this too soon, so we only have data from Thursday here, so it'll be interesting to see how this reacted on Friday. But what we see is this is kind of a contrarian indicator when the put-call ratio gets too low down here, in this case all the way down, say south of 0.6 or so, I think is what a lot of people look at. Then you kind of can potentially have some complacency and some near-term tops. And when you start to rally north of 0.7 or so, then you tend to have excessive fear in there, and you can look at the equity only. You could look at the total put-call ratio. There's a lot of different ways you can kind of combine. You can sort of map out your upper and lower bounds. But for giggles here, we're going to look at where we closed yesterday. 0.51. If we go all the way back on the chart, we just look at the last time we were kind of down here around this price level, you can see that they tend to be at spots where we do have the bottom pane here now is the S&P 500 we're looking at. So if we look at kind of the last time we were this low, you'd get back to March 9th, which was right here, and that started a sell-off of, say, whatever that was, 7% or 8%. If you look before that, we had a small short-term temporary top there, and you can kind of go back. Again, there's lots of ways to interpret this. I am not suggesting going all in on any one indicator here, or that we should build an entire trading plan or thesis because of just this one indicator. It's just something to interesting to look at. It's something that again, to be as objective as possible in sort of the bull and bear case here, I think it's just an interesting chart to show that, hey, look, we've covered 5-6 days moving up. We've got this breakout going, but there's not a whole lot of protection here, right? There's not many people buying up puts at this current price, or at these current levels. So if we did get a catalyst next week that may take this market down, there's not a whole lot of protection out here, indicated by certainly this indicator or the number of contracts out there, that people are protected. So if we did get some catalyst to bring us to the downside, maybe we could accelerate quicker because there's not a lot of protection, and then you're going to see this bid up, so on and so forth. So it's an interesting indicator. I will basically leave it at that. I am not I'm not a master at this. I do not have a trading system built around this indicator by any means. If you are someone that looks at this every single day, leave a comment. I'd love to hear what your thoughts are on it on this YouTube video or on the blog. So I think that's interesting. It goes to show there's a little complacency here, but sort of makes sense. We just had a 5-6 day strong rally covering 4 or 5%. So that's the S&P 500. Lots to talk about there. So let's move on. Russell 2000. Here we go. New closing highs here. I certainly believe that was the case. Or is it only closing highs on a weekly chart? I may have lied at the top of my video. Aha. So we may have only gotten weekly closing highs. So apologies if I lied there. 159.84 is certainly the highest weekly close here. So again, you can see just a nice move back up here to kind of this double top area that we made back in January and then again in March. Let's see if the Russell stalls out here again, or if we can kind of push through it. It is short-term overbought, so it'll be interesting to see. It'll be a reasonable spot to kind of stall out. If it can flag out, move sideways or right underneath that resistance and then break out, that's of course the picture perfect scenario, but we'll have to see. Markets tend to not want to do the easy thing. You can certainly see the slope here is quite accelerated in the short term, but just a steady march higher for the past 6 days. And like I say, it was up 6 days in a row now, the Russell 2000 into resistance. So a little pause here is not unreasonable. And then the NASDAQ 100, you could see into this gap here. Didn't quite fill it yet, but you can see, you know, kind of stuck its nose up into this gap, closes all the way up right around 171 or so, so about 2 points. Maybe the market's got, you know, a date with that early next week, and then make a, you know, make a more informed decision from there type of thing. It's quite extended here in the short term as well, but very much back to the upper end of this range. So that, I think, covers the overall market environment. Essentially, we get a lot of progress done this week. We did break out, cleared out of those short-term levels, and we did break out. Markets are overbought right now in the short term. Doesn't mean we have to stop, but it does mean that we want to be aware of where we've come from and always think about that risk versus reward. And I think that's it. We talked about earnings season almost over. And one last comment, got a lot to mention here, is the 10-year yield. You know, it's interesting. You know, we're certainly media outlets are obsessed with this 3% number. It's a round number. You know, it makes sense. I think the real sort of worry for equity markets, it's not necessarily the 3% number, but it's the acceleration. If we continue to accelerate higher in these short-term rates or in rates in general, that I think is probably the more concern for equity prices. And as it stands right now, we're kind of stalling out here, kind of had this little flag going on, and now we're just kind of messing around here. So be interesting to see if this starts to pick up, if the trend, you know, kind of legs a second leg higher like we saw in January here for yields, if that does start to come home to roost for equity markets. Something to keep an eye on, TNX 10-year Treasury yield. So that covers all what I wanted to in terms of market. Let's go to, or the environment, let's go to some of the other major markets. So you know, kind of the exact opposite, TLT, which is now the bond fund, right? So we're talking the inverse of yields here. As bonds go up, yields go down. This is the long end of the curve here, but you can see we actually rose in bond prices via the TLT this week, slightly higher. You can see a little stabilization here, pretty good. We had this kind of like little head fake higher low that got put in on Wednesday, and you can see bulls kind of back in control here in the very, very short term. Still a messy sort of instance. I'd say range bound between, say, 117 and maybe 121, moving sideways. We're in the middle of that channel right now and heading on up to the north end of it. So that is TLT. Not too interesting to me one way or the other. USO did have a pretty eventful week here. It did end up closing higher on the week. Very high volume, one of the highest volumes of 2018, except for say this week in February here when oil came, you know, crashing down 10%. So we did have a high volume week. We did hold on to gains. We closed off of highs and lower to end the week here on Friday, but still above all short and intermediate term trends. So bulls remain intact here. If we start to lose 14 or so, that would give you some near-term caution, maybe a false breakout here. Otherwise, I think you got to respect the trend. It is a little long in the tooth, but you know, bulls are still in control there. Natural gas also seeing a nice move here, particularly on Thursday, 2.5% to the upside. If we look at this weekly chart now, you can see we're right back to last week's highs. I've tried to play this once or twice this year to the upside. Haven't got the timing right, trying to look for a trade breakout to the upside. Maybe this is the move. We did see some nice volume come in here. 23 is where we've seen it stall out before. I'd like to see it get north of there. That's north of about 280 or so, 281 on the spot price of natural gas. So next week will be an interesting week here to see if we finally do get that breakout. No position at this time. Next up, let's go to metals. So GLD, a little bit of a slump here into the end of the week, but if we look at the week's action altogether, we did rally 46 cents in GLD, very light volume, but it's holding on to the bottom end of the range here, and I do think that's significant. It doesn't look, you know, all that convincing right now. We're not seeing a high volume reversal or washout or sort of an easy trade signal that would you know, that would be a little more enticing that a washout is in fact happening. But I think the fact that we are kind of moving sideways here, especially in the face of an equity market that is moving higher, which we saw 2.5% to the upside this week. We saw, good gains last week as well, or recovery last week as well. And we also have the US dollar, which has been ripping. It stalled out today, but this has made a tremendous amount of progress over the past couple of weeks. So we've had equity markets now recently gone up. We've seen the US dollar continue to go up here, and we still see gold kind of hanging on to support. And I think that is actually a constructive sign. It might still need another 3 months of moving sideways in this range, but I do think it is impressive to see it stall to continue to hold in here. So not doing much with it right now, but if we can continue to build on top of this 124 level, get back up into this range, I think it's interesting. I've been bullish on gold, but really waiting for that upside breakout to get the real momentum going, if that can happen. So that's gold. If we look at silver next here, kind of the same thing. Not a whole lot, to do maybe the here and now, but if we can start to get a break above, $15.90, $16, and then probably more interesting, or more importantly, this kind of fake breakout we saw, false breakout we saw a few weeks ago in the middle of April, north of 16.25, that could really kind of set the stage for the metal rally overall. So silver still waiting for that breakout, but it is moving sideways in this multi-month channel. So that is everything I think I wanted to talk about for the major markets. Let's get into the sectors individually here. We're going to sort the sectors by their weekly return. We're going to look at the performance. And front and center here is biotech, IBB. So IBB saw a 4% rally this week. If we look here at the weekly chart, we're talking about this $100 level, which has been just pounded on over the past year almost of trading, and it continues to hold every time we sell off into this range. Dip buyers just step back into it. And this week we got a high volume sort of bullish reversal with an uptick in volume here. So I think IBB actually staging a pretty interesting reversal. Most of that action is happening here late on Friday. I actually am not 100% sure. There could be earnings related or news. I was not paying attention too much to this sector here on Friday, so I don't know what the specific catalyst was, but we definitely saw some nice movement into this space here, particularly on Friday. It is right back into resistance, which does make this a little more challenging because it is right into these April highs where we chopped around and failed. So we will need to try and get through there, but IBP, nice strong finish to the end of the week. Strong volume coming in there as well. XLE is continuing its march higher here. This has been the leadership group for the past month, at least ever since breaking out here on the 13th of April, and it continues to move higher here. It looks like it's got a date with the old highs back from January, right around $77 or so. So our nice volume continued higher this week, 4%. Energy continues to work itself higher. And financials, which has been kind of a dog for quite a bit, certainly the past couple of months, or certainly the past 5 or 6 weeks. Financials getting a nice snapback this week, 3.63%, clearing above all recent weekly highs here. The 8 and 20 period longer moving averages on the weekly chart, still very flat line. Volume was light this week, but still good progress, taking out and closing above recent highs here. Be nice for the market if we can continue to see this strength hold in financials. Now let's go to the bottom sectors here. We got utilities, so very defensive here, selling off 2% to the downside. We've been moving higher in this channel here. We've tested the lower end of it. We saw a small bounce. Still in a very tough spot structurally. We had this big move down in utilities throughout the end of 2017, throughout most of 2018, and then we're kind of grinding higher in very bear flag like fashion here on the weekly chart. So be interesting to see if this $49 gives way. Utilities could be ready for another leg down. We'll have to see if that does happen. Staples also continuing to look like death here, just selling off for the entire year pretty violently, breaking through support, struggling to stay on off of the lows here. So Staples continuing its downtrend. And then finally, consumer discretionary, which again it rounds out the bottom 3, but it was still up 1% this week. This goes to show you, almost 1% this week, goes to show you that we did have a pretty strong market here overall, trying to break out above this trend line here. Didn't quite clear above the past 2-week highs here, so maybe a little reluctance here in the discretionary ETF as it kind of just sits at these prior highs. So it'll be interesting to see if it can get a little more oomph above 105. And that's it. That is what I have for this week's video. Thanks for putting up with the length of this one, but hopefully it was helpful. And as always, thank you so much for watching YouTube. You can subscribe to our channel. It keeps you up to date with all the latest videos every Tuesday and Friday for market recaps, and then doing Wednesdays for individual trade setups. So thanks so much. Have a great weekend, and I will talk to everyone next week.